So one of our awesome subscribers wrote in and asked the following question. Hey Bob, during the hype of 2021, I bought into ARKK ETF because everybody seemed to be saying it was the best. Instead of doing my own research, I jumped in and bought in. Now I'm down over 60% of my value. Is there a better growth fund to consider? Yes, yes, and yes, times 60%. So there's a lot of hype and talk about the investor Cathie Wood and her ARK investment firm. ARKK is the Innovation ETF that focuses specifically on companies that have a lot of upside potential. This really isn't about making your portfolio grow to a lot of money. It's about offering disruptive, innovative companies. Now, Cathie Wood has said that herself. But the thing is, ARKK did have a beautiful run as a part of having a significant holding in Tesla. That, of course, got everybody that loves to throw in their money as if the stock market is a gambling machine to try to get their next million. The only problem was they all bought in on the high and have felt the pain ever since it's come back down. But if we look here on Seeking Alpha at ARKK and look specifically at the 52-week range, look at that. It was at 126.32 per share, and now at the lowest was $35.14. Now presently, as of the recording of this video, going for $45.90 per share. That is a significant decline. You can see it right here at the bottom, 1 year at a 62.25% decline in the last year alone. The problem we're faced with, how do we find a better growth fund that will make us wealthy long-term and not cost us a lot of money in expenses or potential risky volatile decline in the case of ARKK? If you lost money on ARK and you're willing to share it, drop me a comment down below. How much percentage did you lose from the time that you bought in? Now, let's start with the holdings of ARKK so we can kind of decide what is the best growth ETF for us. So if we come over here to the holdings on Seeking Alpha, it'll tell us what the top 10 holdings are. Right there they are. And you can see right here, Tesla, for example, at only 8.74%. Now that's interesting because last year in July, Tesla represented a total of 10.53% of the overall ARKK holdings. In fact, it was the top holding of this particular fund. The issue though with the rest of these companies is most of them are not fundamentally strong enough yet to get excited about. In fact, they're producing negative cash flow. So on their top 10 holdings, let's take a look here. So CRISPR is negative cash flow. You have UiPath, negative cash flow. You have Exact Science Corp, negative cash flow. You have Intellia, negative cash flow. You have Twilio, guess what? Negative cash flow. Now this right here, these right here, 1, 2, 3, 4, 5, that is 50% of the top 10 holdings within ARKK that represent negative cash flow. Now again, remember what Cathie Wood says, the goal is to be a disruptor and innovator. Well, the problem with that is, that comes with a lot of high risk. So if you're getting into this without doing your research, what you're doing is you're just saying, hey, this sounds sexy, let me get in on it. And then you realize that it's not sexy at all because 50% of it is looking kind of nasty. Now the hope would be these companies turn it around, but the problem with this is you can actually wait until you see fundamentals catch up to itself. So for example, let's take one for example. CRISPR. Okay, so CRISPR right here all of a sudden comes out and you start seeing the revenue increase, you start seeing the free cash flow increase, you start seeing positive numbers, and that negative cash flow becomes positive cash flow. At that point, you can decide to buy in. You're not gonna miss any boat at that point because what's gonna happen is a lot of the value investors, a lot of the hedge funds, a lot of people that are smarter at investing than the average Joe Blow will then decide to start putting money potentially into that stock. And that's why fundamentals are so important. Sure, the people that maybe got in when it was only $1 a share or whatever the price was way back is gonna make a lot of money. But the problem is you don't know what's gonna perform and what doesn't perform. You're taking a risk with your money. And if you're okay losing your money, then maybe that's okay. But long-term, there's better growth funds out there that we're gonna talk about. This brings us to the first point though about losing money with something like ARKK. See, ARKK is an actively managed fund. Cathie Wood and her team are buying and selling stocks within the fund, which means that they can sell at a gain and they pass that gain on to you as the shareholder. If you hold this fund in a taxable brokerage account, like most likely something that's a non-retirement account, that means anytime they sell their holdings within the ARK ETF, those gains are passed on to you and can be taxed up to the ordinary tax rate, which could be up to and including 37% of tax. So if you invested in this long enough, not only did you get a tax bill from 2021's sell off of some of the Tesla and some of the other things that they've been doing within the account, you also are down 60%. You see how this is going? And there's another big expense within ARKK that we'll discuss in just a moment. But let's go back to the question that was originally asked. Is there a better growth fund? Well, considering a 60% drop in ARKK, almost any type of fund would be better than this particular fund. But let's get serious with what could be out there that is a little bit more fundamentally smarter from a growth perspective. First up, let's talk about a relatively conservative growth fund, and then we'll get one that's a little bit more mild and wild. The fund is called VUG, otherwise known as Vanguard's Growth Fund. Let's go pull this up right here on Seeking Alpha, VUG. Vanguard Growth ETF, and you can see right here in the summary section, both Quant and Arthurs rate this at a buy. By the way, if you want to get additional tools just like what we're looking at on this video, you can get Seeking Alpha Premium for yourself. There's an app as well as a web-based environment as we're seeing right here. And just because you're awesome and watching this video, Seeking Alpha is giving you 50% off if you use the link down in the description below. So let's look at the holdings of VUG, and they're gonna be a little bit different than ARKK for a lot of obvious reasons. Look at the top 10 holdings. We have Apple, Microsoft, Amazon, Tesla, Nvidia, Visa, and the Home Depot. But these are very solid, proven companies, producing positive cash flow, seeing growth. Apple is one of the biggest stocks in the world right now. And then if we go back here to the summary tab, it gets a little bit more exciting because as we saw with ARKK, it's not the same with VUG. If we look here, we're down 20%. Year to date, we're down 26%, much different than 60%, knowing that the entire stock market is down in 2022. But if we look up here at the 5-year at 81%, 10-year at 244%, that's looking pretty darn good. Especially if you compare that 10-year at 244% on the Vanguard ETF with ARKK's only 129% on the last 10 years. It had its high, but then because of that crash, it really brought back the 10-year. So that kind of shows you right there that VUG is looking much better than something like ARKK. Now, topped off with an expense ratio here of only 0.04%. Now compare that to ARKK at 0.75%. That's a big difference in cost that we'll talk about in just a moment. So here's the fun part. Let's stack them up next to each other. Let's say you have two people. They each invest $10,000 into one of these ETFs. The first person, we're gonna call this person John Boy, decides to invest $10,000 into ARKK. Then you have this other person, we'll call this person Billy Bob, decides to invest $10,000 into VUG. They invested it just one time, no more, and they invested it in 2015. What would their values be worth today? Let's see, Billy Bob, John Boy, who's winning the overall amount of money? So right here we go. You can see the $10,000 balance grew to $21,750 for ARKK and $23,089 for VUG. That's a difference of 10.92% versus 11.8%. Considering the cost and the expense ratio, VUG and Billy Bob, they're making a little bit more money in the long term versus ARK. But if you want something a little bit more wild than VUG, but not as crazy as ARKK, enter QQQ. Now, this particular fund tracks the NASDAQ 100, the top 100 companies in the NASDAQ index. You can see right here on the 1 year, it's only down 17.27%. If you go to the 10-year on QQQ, up 366%, beating both VUG and ARKK. You can also see the quant rating on Seeking Alpha at a strong buy. Now, as far as holdings, they are similar to VUG, as a result of being in the NASDAQ top 100, Apple, Microsoft, and so on. However, the holding percentages will be a little bit different, and this particular fund only has 100 companies versus VUG, which holds 266 different stocks. Now, the expense ratio a little bit higher than VUG at 0.2%, but a lot lower than ARKK's 0.75. But let's go back and compare this one to the other two. So we have John Boy, who's not doing as well. You have Billy Bob with his VUG, and let's say we have Sally Mae. And Sally Mae is going to say, I'm going QQQ all the way with my $10,000 in 2015. Let's see how she does. So I'm gonna analyze the portfolios. John Boy growing his balance to $21,750. We have Billy Bob at $23,000, and check out Sally Mae. $28,843. That is a return of 15.17%, beating the other two completely. Now, here's what's interesting about this entire thing. If we look at the portfolio growth over time, see how it's kind of going up? And the blue line actually represents ARKK. Now, what you're going to probably see around here in 2021, when Cathie Wood was getting tons of recognition as a result of some of the stock picks that really helped push ARK up, everybody's thinking, well, Vanguard and Invesco QQQ, you're just a bunch of boomer ETFs that are completely and utterly conservative. Look at us way up here at $74,000 versus your measly 25 and 32. But remember, high risk, high reward, and also high risk, high potential for a bad day. And that bad day now, look at this at the very end, we have ARK underperforming both of these funds. Now, this could happen. Back here it did as well. ARK was underperforming back in 2016, both Vanguard and QQQ. Could this happen again, where maybe things change for the better and ARK takes another jump? You don't know. But if you want to be a smart investor, you got to make sure that you feel good about whatever you decide to do. If you decide to buy into ARK and you feel good with that, just get ready for the potential insanity of what is a roller coaster ride. Now, of course, the subscriber that asked me is a little bit concerned about the fact that he is down 60% on his money. So in order to be a little bit more, I feel better about this, maybe consider getting into something like Bug or QQQ. While they're still down from the 2021 height that they were at, they're not down as much. Now, a lot of noobs don't take in the fact that we have something called the expense ratio. I mentioned it earlier in the video. We have 0.04%, 0.20%, and 0.75% in the case of ARK. Those type of expense ratios, when taken out of your portfolio balance every single year, can make a significant impact on your long-term holdings and your long-term growth potential, depending on the fund. Thanks to NerdWallet, they have this particular calculator, and I want to show you an example of what this really means. So even though this is meant for mutual funds, we'll do it in the case of our ETFs. But if you look at the initial investment amount, let's do $10,000. Future plan contributions, we're going to say $1. And time horizon will be 7 years from 2015 to 2022. Rate of return. Now, what we could do here for the rate of return is take the average here. Let's just say on the conservative side, 11% as the average. So our rate of return is going to be 11%. And the expense ratio in the case of ARK is 0.75%. If we calculate this, look at the cost of the fees over that period of time. Your ending value would be $19,809. Your ending value gross would be $20,772. So you're spending $962 to own ARK. But in the case of Vanguard's VUG, considering the same exact example here, 11% return on the $10,000 for 7 years, if we change this from 0.75 to 0.04, your cost of fees will go from $962 down to only $52.33. So what you have to figure is, if I'm losing money because of the market value going down, stacked on top of the fact that the expense ratio will cost money, even though they pull it out of your portfolio balance, it's something that you need to consider for the long term. So beyond just Bug and QQQ with some alternatives, what are some other great ETFs that could potentially help you grow your balance over the long term? Well, in that case, check out this video next that'll guide you through that, and we'll see you over there.